Warsh just spoke. Here's exactly what he said and what it means for silver. Yesterday, the most powerful central banker on the planet stood in front of the cameras for the very first time. And what he said should have every silver investor paying very close attention right now. Because the message Kevin Warsh delivered didn't just move markets, it rewrote the playbook for the next 12 to 24 months. And buried inside that press conference, hidden in plain sight, was one of the most significant signals for silver we've seen in years. Most people missed it completely. You won't. Stay with me. Because in this video, we're going to do something the financial media won't do. We're not going to skim the headlines. We're going to go word by word through what Warsh actually said, decode what it means in real economic terms, and then connect it directly to silver, the one asset that almost nobody is watching closely enough right now. By the end of this video, you're going to understand why the single press conference may have just set the stage for silver's next major move. Here's what we're going to cover. First, who is Kevin Warsh, and why does his every word move billions of dollars? Second, what exactly did he say yesterday, and what does it mean? Third, why the specific path Warsh just confirmed creates a uniquely dangerous and uniquely opportunistic environment for silver. And fourth, what history tells us happens to silver during periods exactly like this one. Let's go. Part 1. Who is Kevin Warsh, and why does this matter? To understand why yesterday mattered, you need to understand who Kevin Warsh is. This is not a bureaucrat who rose through the institutional ranks of the Fed, kept his head down, and waited his turn. Warsh is different. He's been a vocal critic of the Federal Reserve's communication style, its forward guidance, and what he calls the bloated interventionist balance sheet the Fed built over 2 decades of crisis management. He promised, before he was even confirmed, that this would be a, and I'm quoting directly, regime change. That's not normal language from a Fed chairman. That's a declaration. Trump appointed him with one goal in mind: cut rates, get the economy moving, make borrowing cheap again. But here's where it gets interesting, because what Warsh said yesterday was the exact opposite of what Trump wanted to hear. And the fact that he said it anyway, that tells you everything. Part 2. What Warsh actually said. Let's go through it. Warsh took over as Fed chairman on May 22, 2026. Yesterday, June 17th, he chaired his very first FOMC meeting, his first real decision, his first press conference. The markets had been watching for weeks, and the decision was rates stay unchanged for the 4th consecutive meeting. The benchmark overnight rate remains in a range of 3.5% to 3.75%. Fine. Expected. Markets weren't surprised. But what happened next was not expected. 9 of the 18 Fed officials, 9, penciled in a rate hike before the end of 2026. Not a cut, a hike. A complete reversal from where projections stood just 3 months ago, when the average Fed official expected a rate cut this year. Think about that for a second. 3 months ago, the narrative was, rates are coming down. The pivot is happening. Now, the Fed is signaling rates could go higher. Why? Because inflation is not under control. The Consumer Price Index in May came in at 4.2% annually. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, is running at 3.8%. The Fed's target is 2%. They are nearly double their target. And Warsh made his position unmistakably clear. He said, and I want you to hear this carefully, the commitment to deliver is strong, unanimous, and unambiguous. And that's, I think, an important message we've missed for 5 years. And we're going to fix that. 5 years. He basically said the Fed had been soft on inflation for 5 years. And that ends now. This is not a chairman preparing to cut rates. This is a chairman drawing a line in the sand. Now here's the part that the mainstream financial media largely glossed over. Warsh refused to submit his own dot. The dot plot is the Fed's famous projection chart where every official places a dot indicating where they expect rates to go. Every other official submitted their projection. Warsh didn't. He's the chairman of the Federal Reserve, and he deliberately withheld his own forecast. Why does that matter? Because it means nobody, not Wall Street, not traders, not analysts, knows what Warsh is actually thinking. He has made himself strategically unreadable. He's signaling that he will not be guided by market expectations. He will not tip his hand. He will not be pressured. This is a man who intends to surprise markets, and markets hate surprises. Part 3. The inflation trap. Now let's zoom out, because to understand what all of this means for silver, you need to understand the trap the Fed is currently in. And make no mistake, it is a trap. Here's the situation. Inflation is running hot. The Fed needs to fight it. The textbook response is simple. Raise rates, slow borrowing, cool the economy, bring prices down. But here's the problem. The United States is carrying over $36 trillion in national debt. The interest payments alone are now one of the largest single line items in the federal budget, running above $1 trillion a year. Every time rates go up, those interest payments get worse. The deficit gets bigger, more debt gets issued, and the cycle feeds on itself. And that's before you factor in the geopolitical environment. Since the Iran conflict that began in late February, energy prices have spiked. Oil, natural gas, they've all contributed to the 4.2% CPI print we just saw. This isn't purely a monetary inflation problem. There's a supply shock embedded in it. So what does the Fed do? If they hike, they risk cracking the housing market, triggering a recession, and making the debt servicing crisis worse. If they don't hike, inflation stays elevated, or worse, reaccelerates. There is no clean exit from this trap, and historically, every single time the Fed has found itself in this exact position, hard assets have outperformed. Gold and silver. Because when confidence in the central bank wavers, when the credibility of monetary policy is in question, when inflation is above target, and the tools to fight it create new crises of their own, money moves. It flows out of paper assets, and it flows into things that can't be printed. Part 4. The silver connection. Now let's talk specifically about silver, because most people, even people watching this channel, may still be thinking about silver as primarily a monetary metal, a hedge, a store of value, and it is all of those things. But what makes this particular moment different, what makes 2026 structurally unlike almost any period in silver's modern history, is the industrial demand side of the equation. Solar energy, electric vehicles, AI infrastructure, defense electronics, medical technology. Silver is the most electrically conductive metal on Earth. There is no substitute. There is no synthetic replacement. Every solar panel, every EV battery management system, every data center heatsink, they all require silver. And global demand is not slowing down, it is accelerating. Meanwhile, primary silver mine supply has been structurally flat for years. The big silver mining projects of the 2000s and 2010s have been depleted. New discoveries take 10 to 15 years to bring to production. The pipeline is thin. So here's where you are. On one side, you have a macroeconomic environment where the Fed is stuck, inflation is elevated, the dollar's long-term purchasing power is under genuine structural pressure, and the new Fed chairman is deliberately keeping markets in the dark. On the other side, you have an industrial commodity running a deepening annual supply deficit, with demand growth tied directly to the most powerful secular trends of the next decade. Most investors see one of these stories. Smart money sees both. And when both stories align, when the monetary case and the industrial case converge simultaneously, that is historically when silver moves most violently to the upside. Not gradually, not slowly, violently. Part 5. The Warsh regime and what comes next. Let's come back to Warsh for a moment, because there's something else that came out of yesterday that very few analysts are discussing. He announced 5 internal task forces at the Federal Reserve: communications, balance sheet, operations. These are not small procedural tweaks. This is an institutional overhaul of how the most powerful central bank on earth operates, communicates, and manages its nearly $7 trillion balance sheet. Warsh has been on record for years saying the Fed's balance sheet is too large, that the Fed has inserted itself too deeply into day-to-day financial market plumbing, that it needs to step back, that it needs to operate with clearer rules, smaller footprint, and less interventionism. Here's why that matters for silver. If Warsh follows through on balance sheet reduction, and the early signals suggest he is serious, that is a tightening of financial conditions beyond just the rate decision. Less liquidity, less easy money floating through the system. In the short term, that can create volatility in precious metals. We already saw it yesterday. Gold fell more than 2% on the day. Silver felt pressure. The dollar strengthened about 1%. But here's the thing about short-term volatility in structurally bullish assets. It creates buying opportunities. Every time in history where financial conditions tightened, real assets sold off initially and then reversed sharply as the inflationary reality reasserted itself. 1970s, the early stages of the Volcker era, the post-2008 balance sheet expansion period. Every single time, the pattern was the same. Initial pain, then the repricing. and silver consistently moved more aggressively than gold during the repricing phase, because silver has that industrial demand floor underneath it, holding it up even as the monetary argument plays out. The gold-silver ratio right now is still historically elevated. That means silver is cheap relative to gold by a multi-decade standard. When monetary stress meets industrial demand shortage, that ratio historically compresses. Silver closes the gap, fast. Part 6. The hidden signal. Now I want to bring something to your attention that I think is the most underappreciated part of the entire Warsh press conference. He said the Fed's commitment to 2% inflation is, and again I'm being precise here, the objective where, quoting, the 2 is to the left of the decimal point and 0 is to the right. He was being emphatic. 2.0%, not 2.5%, not a revised target, not a range, 2.0%. But here's the critical question. Can he actually get there? CPI is at 4.2%. The Fed's own officials just projected a rate hike to deal with it. And yet the structural drivers of inflation, energy supply shocks, geopolitical disruption, ongoing fiscal deficit spending, massive government debt rollovers, none of those are solved by a quarter-point rate hike. If Warsh tries to crush inflation with rate hikes in this environment, he risks a hard landing, a recession, credit stress, market dislocation. If the inflation proves stickier than expected and rate hikes don't work fast enough, the Fed's credibility takes a hit. And when central bank credibility erodes, historically, gold and silver benefit most. Either path leads to the same destination, and that destination has silver's name written on it. Let me leave you with this. Yesterday was historic. The new sheriff of global monetary policy sat down at his desk, picked up the microphone, and told the world, the era of easy money is over. Inflation will be fought. There will be no coddling, no soft landings promised, no forward guidance offered. Markets didn't like it. Stocks fell. Short-term yields jumped. The dollar strengthened. Gold pulled back. But here's what history tells us about moments exactly like this. The repricing of silver, the full repricing that reflects both its monetary role and its irreplaceable industrial demand, has not happened yet. The supply deficit is growing. The macroeconomic pressure is building. And now you have a Fed chairman who just sent a very clear message. This battle with inflation is going to take time. It's going to be painful. And nothing about the next 12 to 24 months is going to be easy. In that environment, hard assets with real-world utility and monetary heritage don't just hold value. If history is any guide, they compound it. The question isn't whether the macro environment is complex. It clearly is. The question is, when the next leg of the story unfolds, when the silver chart starts making new highs and the financial media finally starts covering it, will you be the person who watched this video and was already positioned? Or will you be the person reading the headlines, wishing you'd paid attention 6 months earlier? Think about that, and I'll see you in the next one.